This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, July 2, 2026, and this is the New York pre-market. Now, let's get into it. The S&P 500 looks calm, hovering near $745.76, but look closer at the Nasdaq. The QQQ has dropped 1.52%, shedding losses that suggest a structural rotation is underway. We are seeing a 4.75% performance gap opening up between technology and financials, a split that is redefining the entire equity landscape for Thursday morning. Turning to the calendar, we have a quiet session ahead. There are no major S&P 500 earnings reports scheduled for the next 48 hours. Today brings filings for smaller caps like AIV and BMR, and tomorrow we see AUK and APM, but none carry enough weight to drive the broader market. Instead, the tape is being driven entirely by macro data and sector rotation. Let's dig into the divergence. Here is the snapshot. SPY is at $745.76, essentially flat. But QQQ is at $725.17, down 1.52%. IWM is holding at $299.32, down less than 0.5%. And look at the sectors. The technology sector is dragging at minus 2.57%, while the financial sector is surging 2.18%. That is the story. Let's start with the big picture. Pulse, walk us through what this sector spread tells us about the mood. It tells me we are watching a definitive structural rotation, not a panic. The crowd is actively deleveraging from high-duration technology. You've got a 4.75% performance spread between the technology sector and the financial sector. Capital is fleeing growth assets because of sticky inflation. Core PCE at 3.41%, CPI at 4.17%. And parking it in financials that benefit from the 3.63% Fed funds rate. The VIX is at 16.45, which screams complacency, but the money movement is aggressive. They aren't scared, they are reallocating. So the low VIX masks the intensity of the trade. Grid, is this playing out technically on the charts?
Absolutely. On the SPY, support is holding near $742.38, which is keeping the broader index stable. But look at the QQQ. It's closed at $725.17, testing the lower bound of its 10-day range, which stretches from $702.81 to $745.45. We saw lows of $702.81 back on June 26, and now we're circling those levels again. The technical structure is compressing. Every bounce in the Nasdaq is being met with distribution. Meanwhile, the financial sector surge to $54.78 is validating a breakout structure that has been building since the yield curve flattened.
CIPHER, does the fundamental side confirm this move, or is there a disconnect?
There is a massive dislocation. Institutional flows are abandoning the soft landing tech narrative, with the 10-year yield holding at 4.44% and the 10-year 2-year spread flat, plus 0.31 basis points, the math no longer supports infinite multiple expansion for tech. I'm seeing heavy outflows from the technology sector components and inflows into communication services, which is up 2.44% today. The market is pricing in a higher-for-longer environment where net interest margins drive profits, not revenue growth multiples. The hedge funds are shorting duration and going long credit.
SPECTER, is this a healthy adjustment, or are we risking a sharper correction?
It's fragile. You have a flight to quality that is masking underlying decay. The fact that QQQ is down 1.52%, while the VIX drops to 16.45 means volatility suppression is preventing a true repricing of risk. If that 10-year yield holds above 4.44%, and it threatens to break 4.5%, the soft landing trade fractures. We are seeing a bifurcation where the top half of the market survives on financial strength, while the bottom half gets crushed. Watch the VIX. If it spikes above 20, the quiet exit becomes a noisy crash.
Let's zoom in on the specific movers that are decoupling from this trend. MicroStrategy, MSDR, is up nearly 6% pre-market. CIPHER, what is happening with that name?
MSDR is at $98.90, up 5.9%. But here is the anomaly. News sentiment is bearish, sitting at negative 0.56. Normally, a price spike with negative sentiment suggests a short squeeze or a specific corporate action that is ambiguous to the street. The fundamentals don't explain a 6% gap up in a risk-off environment. It's purely speculative flow overriding the macro headwinds.
And that's the danger sign. Retail traders are piling into MSDR and coin despite the negative news flow. This is classic buy the rumor, sell the news reversal, or pure gambling. You've got coin also up 4% at $165.66, but with negative sentiment of negative 0.33. The crowd is chasing alpha in a sector that is generally getting sold off. They think they are buying Bitcoin beta, but they are actually buying leverage in a falling market.
Technically, those levels are isolated islands. MSDR and coin are not respecting the broader QQQ resistance structures. They are gapping up into thin liquidity. Once that initial burst of volume fades, there is very little technical support holding them up if the broader market rolls over. They are running on fumes.
Let's talk about the index leaders and laggards. The QQQ is struggling. Grid, what do you see at $725?
$725.17 is the pivot. If we hold above the recent consolidation lows around $705, we might see a dead cat bounce, but the 10-day range compression suggests energy is draining. The 5-day low was $702.81, and we are nowhere near reclaiming the upper quartile of that range. The chart shows weak hands exiting. Every rally into $730 is getting sold. The trend is down until proven otherwise.
And that brings us to the core conflict of the morning. Grid sees weakness in QQQ, CIPHER sees structural outflows from tech, but SPECTER warns that the VIX compression at 16.45 hides the risk. The synthesis here is simple: the market is splitting. The good part of the market, the financial sector, the healthcare sector, communication services, is doing fine. The bad part, the technology sector, the utilities sector, the energy sector, is breaking. The SPY at $745.76 is being propped up by the winners, making the average investor feel safe while the growth engine stalls.
What about the defensive play? Healthcare is up 0.55%. Is that where the money is going?
The healthcare sector is up 0.55%, and it's up 4% for the week. Yes, this is the safest harbor. With unemployment at 4.3% and payrolls moderating, healthcare offers earnings visibility without the rate sensitivity of utilities or the valuation risk of tech. Institutions are moving cash here because it's boring and profitable. It's the ultimate sleep well at night allocation in a sticky inflation environment.
But don't confuse safety with excitement. The crowd is bored with healthcare. They want the meme-driven volatility of MSDR and coin. That's why those names are popping while the healthcare sector drifts slowly higher. Sentiment is bifurcated. Smart money is hiding in the healthcare sector. Dumb money is chasing pumps in MSDR. SPECTER, what happens if the yield curve inverts further? You mentioned the 10-year 2-year spread is flat at plus 0.31 basis points.
That flatness is the trigger. Historically, a flattening curve precedes growth slowdowns. Right now, financials benefit from higher rates, but if that spread inverts, net interest margins compress. The very sector protecting SPY, the financial sector, would become vulnerable. We are walking a tightrope. As long as the 10-year stays at 4.44%, the financial sector works. If that yield moves significantly, the defense collapses.
Let's look at the Dow Diamonds. It's at $522.40. How does it compare?
Diamonds is at $522.40, trading within a range of $519.62 to $526.72. It's less volatile than QQQ because it's weighted toward industrial and value stocks that are less sensitive to duration. It's holding steady, which reinforces that the pain is concentrated in the tech-heavy Nasdaq, not the entire economy. The market isn't crashing, it's reshuffling.
Exactly, this is a rotation, not a recession. The narrative is shifting from growth at any cost to yield and value. The data supports this. CPI at 4.17% prevents rate cuts. Therefore, growth stocks with high multiples suffer, while banks and insurers thrive. The QQQ drop is the market agreeing with the inflation data.
We have time for one last look at the broadest context. SPY is at $745.76. Is there any sign of broad-based strength?
Only the illusion of it. SPY is near the top of its recent range, but that's entirely due to the weight of the financial and healthcare sectors. The breadth is poor. If you remove the financial sector and the healthcare sector, the index would likely be in the red. The support at $742.38 is psychological and technical, but it doesn't reflect the health of the underlying 500 companies.
Agreed, the capital flows are selective. I'm seeing institutional buyers accumulate in communication services and the healthcare sector. I'm seeing sellers unload in the technology sector. The SPY composite number is misleading. Look at the constituents, not the index.
So, to summarize the pre-market picture, we have a structural rotation away from tech and into financials and healthcare. Inflation data keeps the Fed on hold, supporting yields. Specific names like MSDR and Coin are decoupling due to speculation, not fundamentals. And the VIX remains low, potentially underpricing the risk of a sharp re-rating in tech if yields rise further. What should traders watch for tomorrow? Keep an eye on the 10-year Treasury yield. If it pushes above 4.5%, the current rotation could accelerate violently. Also, watch QQQ. If $725 breaks decisively, the technical damage to the Nasdaq could deepen, forcing more capitulation in the tech sector. Thanks for joining us on the ShadowQuant Equities edition. Remember, this is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.